One of the most common mistakes I see in people's 401k is not considering expense ratios when making their investments. Most people are like, hey, what's the difference between a quarter percent and a half a percent? It can't really be that much money. Well, over 40, 50, 60 years, it's a significant amount of money, and I'm going to show you just how much. When scrolling through all these investment funds, it could be a super daunting task. So what we're going to do is we're going to compare the expense ratio of the Vanguard 500 index fund. And let's see, we like aggressive growth, right? Everybody likes aggressive growth. So we're going to go to the Cohen and Steers Real Estate Security Fund. The one on the left is the Vanguard 500 index fund, and the one on the right is the Cohen and Steer Real Estate Securities. We can see there's a significant difference between expense ratios. The one on the left is 0.04%. The one on the right is 0.75%, 0.75. Okay, let's plug them into our NerdWallet calculator and see how much money we're losing by investing in a company with such a high expense ratio. This first chart is our 401k balance at retirement with the Vanguard S&P 500 index fund with a 0.04% expense ratio. Okay, so we did this at a $65,000 salary, starting at 25 with zero in, with a 7% compound annual growth rate. So at the age of 67, when we retire, we're going to have $2 million in the bank for our 401k. But check this out. This is the specs with the 0.75% expense ratio. So we're going to lose out on almost $400,000 if these two funds get the same compound annual growth rate of 7%. Our 401k balance at retirement will be $1.68 million with an expense ratio of 0.75%, nearly $400,000 less than the S&P 500 just because of the fee difference. The difference between 0.04 and 0.75% is significant, and we will lose out on almost $400,000 if we get a fund with the same compound annual growth rate with the higher fees. I want that 400k, don't you?